T-10 to showtime. On my mark, roll intro and mark. Camera's ready. Camera 1 check. Camera 2 check. Audio. Roll guest package. Action. The views and opinions expressed in this podcast are those of the individual speakers and do not necessarily reflect the official positions of Visa or the speaker's employers. This podcast is intended to provide general information and should not be considered health, legal, tax, or financial advice. Todd, coming to you in 3, 2, 1, action. This is Policy Sandbox, a collaborative space for ideation at the intersection of payments, commerce, and public policy. In this episode, we'll dig into crypto assets and on-chain finance.
Stablecoins have lowered the barrier to entry so much to building a financial services product that they can launch a product and scale it to people in 100 plus countries within weeks. Like, that now exists. And there's no way to kind of put that away. It's just, this technology is out there.
That was Cuy Sheffield, head of crypto here at Visa. Cuy has done more than anyone to shape the way I think about the power of blockchain technology, and I think this conversation will show you why. Cuy helps financial institutions understand the opportunity of digital assets and build solutions that deliver value to real people in real places. He's also the host of the Tokenized podcast, so maybe I can get some podcasting tips. But most importantly, I'm looking for tips on what crypto really means for the future of money. We'll also hear from Sophia Lopez from Kaleido, Candace Kelly from the Stellar Development Foundation, and Alisha Chhangani from the Atlantic Council. Welcome to the Policy Sandbox. Let's dig in. I'm here with my friend Cuy Sheffield. Cuy is the head of crypto at Visa. Probably the smartest person I know when it comes to digital assets. Cuy was the first person to ever tell me about stablecoins, and now I feel like as I fly around the world and meet with policymakers, that's the number one issue on everybody's mind. So I remember back to your very early instruction to me of what the hell a stablecoin is. But more importantly, at Visa, you're really, in so many ways, the visionary behind everything we've done around digital assets, and that's been a huge source of impact on both the on-chain ecosystem and really bringing digital assets into the mainstream. So, Cuy, welcome to Policy Sandbox.
Wow, thanks for having me. And I would say that, I've just been incredibly grateful to have the opportunity at Visa and to have an amazing team, on the policy side, on government engagement, on the product side. And so there's so many people that have worked so hard behind the scenes for 7+ years, to get to where we are today. And, the way I like to think about it is we're just getting started. Yeah. We're really just getting started. So there's a huge opportunity for Visa in the space. And I fundamentally believe this technology is going to have a major impact on the world. And I think there's a lot that Visa could do to continue to drive it forward.
Well, you've convinced me, but maybe we can have a conversation about the journey that got us to this point, because I think when I think about it in terms of past, present, and future, when we first started exploring as a company, making our first foray into crypto and tokenization and stablecoin, there's some very different narratives out there. So maybe if we can start from maybe an historical perspective. What were some of the narratives that have evolved, not just from Visa, but really that were out there? I mean, I see this from a public policy perspective, where first it was seen as this very uncertain thing, but it was like gambling. It's like, don't risk what you can't afford to lose and we'll be fine. Now the conversations are very different. Walk people through the journey of how this whole notion of moving dollars and fiat currencies on chain has evolved over the last, say, decade or so.
Yeah, it's a great question. So when I started going down the crypto rabbit hole, it was really summer 2017, and I was learning about payments during the day at Visa, and I was going to crypto meetups in San Francisco at night. And I had this really interesting experience that this was really pre-stablecoin, in the sense that there weren't really, stablecoin wasn't really a term. People weren't really talking about it. There weren't really any that had gotten traction. And so when people thought about crypto, they thought about Bitcoin. And I remember going to crypto meetups, and I would ask people what they thought about payments. And they were like, oh, everyone's just going to pay for everything with Bitcoin. I was like, wait a minute, like that doesn't seem right. Like, I didn't want to spend my Bitcoin. I thought Bitcoin was much more digital gold than it was digital cash. And so it seemed very clear to me that Bitcoin itself, while had a strong community and wasn't going away, was not really well positioned to become a medium of exchange and to be used for payments for many reasons. And I think since then, we still don't see any real demand for Bitcoin as a medium of exchange. And so I think the concept of stablecoins started to emerge, 2018, 2019. The Libra project was a major inflection point. I think they introduced the world to the concept of a stablecoin and this idea of, okay, you can have a technology that is a blockchain network, but you don't have to have a volatile cryptocurrency to transfer value over it. And so it kind of decoupled, the currency and this crypto libertarian, let's create new money from the technology, which was a blockchain that was just kind of a new modern infrastructure that existing forms of money, could run on. Now, I think with Libra, it started with a basket currency, and that had its own, many issues, with trying to enable that. But even after Libra, folded, there was this emergence of dollar-backed stablecoins. And so I remember reading the white paper for USDC and saying, this seems like a pretty pragmatic, practical solution that you could take a dollar, put it in a bank account, do it in a transparent way where you can disclose what the reserves are, and then you can issue a token on a blockchain that represents that dollar. And so when we looked at stablecoins, back in 2018, 2019, our approach was these aren't new currencies. They're just a new form factor for existing currencies. It's just a new way to upgrade some of the technology and the plumbing by which money is represented. And so that was incredibly exciting for us. And so, we started, getting embedded in the ecosystem, working with companies, like Circle, like Coinbase, who are at the forefront, figuring out how we can help them with fiat on-ramps. How do you buy a stablecoin? And then many of these companies started to want to have off-ramps. And how do you spend from a balance of a stablecoin? And so it became very apparent to us, in 2020, 2021, that there was real value and merit to this technology, but there wasn't a regulatory framework. There wasn't clarity. There's a big question of, is this just going to be on the frontier and on the outskirts, or would this ever come into mainstream payments and finance? And that's where there's been so much progress, over the last 5 years towards that. We'd love your view of how did the policy side come into this, regardless of what the crypto people are doing?
Like all waves of innovation in finance, it follows the similar pattern. I mean, I think it's just been maybe a little bit accelerated because everything just moves so much faster now. But going back to the beginning of financial regulation, there was always this sort of healthy tension between desire to unlock growth by making the financial system allocate capital more efficiently and hopefully drive capital to the highest productive use, which is really the engine of the economy. And the desire to have financial stability and make sure that there was going to be, a very low risk of any kind of financial crisis. And if there was one, that it would be a relatively shallow crisis and wouldn't cause some kind of depression. And I think that in the conversations we've had, often you and I together, either in advance or during or after these meetings with policymakers over the years, what we've seen is the technology itself has changed quite a bit from 2018. Understanding of blockchain has evolved tremendously over the last, I would say, 5 or 6 years. And we now have real world deployments of stablecoin at some scale, so people can actually see for themselves. It's not speculative, and they don't have to look into some future scenario to imagine what might happen. They can actually see what's happening. And you've absolutely helped guide that conversation with some of the things you've built around, for example, the on-chain analytics dashboard, where you can provide kind of a real-time view of what's happening in the stablecoin ecosystem at a given moment in time. That data is extremely helpful. I also think that there are still some differences of opinion as we move from one jurisdiction to the next. And maybe just to kind of give you a sense of how this came up in some recent conversations, I was in Davos a few weeks ago, and I had a chance to speak with Sophia Lopez, who is the founder of a blockchain company called Kaleido. And they do a lot of work for enterprise blockchains. They're actually working with a lot of central banks as they think about moving fiat currencies on chain. Here's what she had to say.
This is now my 7th year attending, and sort of pre-COVID, post-COVID, you see a lot of evolution and changes. And then in the space I'm in, which is digital assets, tokenization, and blockchain, like a huge transformation in the types of conversations and where those conversations are happening from 7, 8 years ago. on the promenade, very crypto focused and in their early years. And now, when you look at, all the different FMIs and institutional players who are discussing what they're doing, like tokenizing their assets, all their plans across, exchanges like NASDAQ, DTCCs here, they had plans to tokenize their business, their assets in different ways, the large CSDs, and then of course all the, the banks, all sorts of FMIs. So it's really become an institutional conversation. But Hong Kong, Singapore MAS, we've done multiple wholesale networks with composable finance, institutional DeFi with largest banks and asset managers. This global layer one, where it's like a financial rails built by financial services for financial services. Brazil is a really big one.
I'll get your reaction to Sophia's comment about the distinguishing TradFi from crypto is becoming less and less obvious, and then maybe we can talk about some other implications for policy.
Yeah, I'd say that the technology's come a long way. Like, I remember in the early days of stablecoins, while the concept made sense, you represent a fiat currency on a blockchain, and blockchains are global. They can work 24/7. They don't take bank holidays. That was one of the major benefits that we said, okay, you can just move money 7 days a week. But generally, the early blockchains were still pretty slow and pretty expensive. They were doing maybe a few dozen transactions per second. Gas fees on Ethereum would spike as high as $30. And so they were still pretty clunky and hard to use. You had to really seek them out. You had to really be in the crypto ecosystem. The only people that were using stablecoins really up until, let's say, at least 2020, 2021, were crypto traders. And they were people who already had exchange accounts, they already had wallets, and stablecoins solved a real problem in the crypto markets where you could move funds between exchanges, and you could do that 7 days a week. But it wasn't really something that someone who was not crypto trading would have like a clear interest in it. Then we saw 2022, 2023, this decoupling where there's a pretty brutal crypto bear market. You had exchanges that were exploding, you had all of these issues. And I think it would have been easy to say, oh, well, wouldn't stablecoins just go away? Because crypto trading was down a lot and nobody really was interested in buying Bitcoin in 2023. But we saw stablecoins continue to grow. And the usage was people, particularly outside the United States, who were downloading wallets and exchange accounts and just using them to hold and transfer dollars. They had no interest in trading Bitcoin. And so we saw multiple companies that were exchanges, and their primary business in 2021 was selling Bitcoin. And their primary business in 2023 was doing local fiat to stablecoin conversions. And they went from a fraction of their volume being in stablecoins to 90+% of their volume in stablecoins. And so we saw stablecoins start to move out of the crypto ecosystem and really into fintech. It was always confusing to me if people would say, oh, there's fintech and then there's crypto. It's the same thing. It's you can't not say that stablecoins are financial technology. And then you had a new class of builders, and I think Bridge is a great example of this. They were doing nothing with crypto. Rain, they were doing nothing with crypto. They were just entrepreneurs that wanted to build financial products and payment products, and they found that building them on top of stablecoin rails gave them a number of competitive advantages and enabled them to offer products that their customers wanted. And so I think we saw that decoupling happen in 2022, 2023, but it was still bottoms up, early stage new fintechs. And I think now post-Genius Act, with the regulatory clarity in place, it's not just bottoms up fintech, it's now traditional financial institutions that are saying, wait a minute, look at all these companies who have popped up and have been building real businesses on top of this technology. It was challenging when TradFi couldn't compete because there wasn't the regulatory clarity. They can't just launch a product without it being clear what the rules are. Now that those rules are coming in place, now we expect there's going to be massive competition because you have fintechs who've been building at this for a while that understand the tech, that are starting to scale. But then you have incumbents who have distribution, who have trust, who have licensing, who are now starting to adopt the technology. And we think that that is a great thing for the overall financial ecosystem to have competition, to have innovation. And stablecoins have really driven a lot of that.
Much more choice for consumers, much more ways to move money. In a previous episode, we talked about the trend toward fragmentation. And I think that's probably a great way to think about the present and maybe look a little bit into the next wave of on-chain finance, because as you've correctly pointed out, we are seeing much more maturity in the market, much more sophistication, much more regulatory clarity, but not consistent regulatory clarity. So different jurisdictions have very different attitudes about what an optimal stablecoin regulation would look like. And I think, as you surely are aware, we're getting further into this debate around multi-jurisdiction issuance of stablecoins and what the financial stability implications of that would look like. And so one of the benefits potentially that we can provide as a global network is to sort of abstract away some of that friction. But stablecoin itself is kind of a friction-reducing innovation. So maybe to get your thoughts on that, how should we think about this idea of regulatory interoperability?
Yeah, it's a great question. I think it's a challenging one because stablecoins are such a global product. We haven't really seen financial products that are as natively global as stablecoins are. That on day one, once a stablecoin is issued on a public blockchain, that can technically be transferred and accessed by any wallet in any country across the world that can connect to the internet and connect to that blockchain. And stablecoins have grown, and the wallets that are really building on top of them, you see wallets that might be half a dozen people building it in a garage that launch in 100+ countries. And so we're used to a world where financial services were market by market, and it was, you raise a bunch of money, you build a big team, you get licenses, and you launch in one country. And then maybe 3 years later, you had a second country. And then maybe 3 years later, you had a third. We have not seen this world where you have a handful of people who didn't even raise any venture capital, that stablecoins have lowered the barrier to entry so much to building a financial services product that they can launch a product and scale it to people in 100+ countries within weeks. Like, that now exists. And there's no way to kind of put that away. It's just this technology is out there. And I think that there are very positive things about that, because if you lower the barrier to entry to creating new products, you get many new products that would have never existed before that drive competition, that drive consumer choice, and it's great for the economy. But on the other hand, how do you manage the risk? How do you manage supervision? How do you manage disclosures? If you have thousands of new financial products that are being created every month, like, most regulatory systems were not built to deal with that type of volume. You're used to, there's a phase of, okay, how many new banks are created each year? How many new fintechs are created each year? Take that and times it by 100. And that's what stablecoins are doing, is it's a developer can build a financial product. Now, there's some new mechanisms like the concept of self-custody wallets, and the developer itself doesn't have control over the funds, the consumer's managing the funds. But I think it's incredibly challenging to figure out the right regulatory environment for that. I do think the general principles that you can start with is this technology isn't going away.
Yes.
It exists, and likely it exists in your market. And so it's not like, oh, you're looking at it from afar. It's like ask your kids, ask their friends, they probably use them right now. And so then you could say, all right, well, you have two options, in my opinion. You could either say, how do we create, the right guardrails and rules to bring that technology into our formal financial system, to let banks, highly regulated institutions, be able to build products that can then be offered to your citizens, or you can try and stamp it out and make it illegal, ban it, go door to door and confiscate people's phones. And I think that's a hard one to do.
It's very hard to do. Cuy, let me just tell you, I had a great conversation with Candace Kelly. She's at Stellar Development Foundation, a partner of ours in many areas, but also a very deep thinker on this exact topic. And I'll just play a clip of what she said to me when we sat down on Policy Sandbox.
I feel like in the 5 or so years that I've been coming to Davos, there is actually more of a convergence of those conversations. So it used to be there was traditional finance, there was a blockchain, and there were geopolitical conversations. You can't not talk about it at this point, right? Especially at this Davos. And so the recognition of how that is affecting the innovators and the blockchain folks is, that is to me very encouraging. Interoperability, harmonization, I think that's the key distinction, because there are some people who think global regulation, that is never going to happen. Whether it's the technology being interoperable, the technology is borderless, right? And so to be able to take advantage of that, yes, the regulations have to be interoperable or harmonized or whatever. They don't have to be exactly the same, but they do have to be implemented.
It's not just about payments. Like stablecoins are this very general purpose technology, and they sit at the intersection of capital markets, of lending, of payments, of commerce, of all of these different areas. And so I think if you look at it just as one thing and you treat it just as, oh, this is a payment product, then you miss the fact that there's a massive transition happening right now in rewiring the plumbing of capital markets, bringing all types of money market funds on chain, other types of securities, equities, bonds, commodities. Those are coming on chain. And so like when people think about stablecoins, they think about a remittance app. Like if you have brand new assets or some of the largest assets in the world represented on this database, well, you also need a form of cash represented on the same database to buy them. If the US financial system is going to upgrade the plumbing around capital markets and payments and lending, it's very hard to just sit that out and to say, you know what, we're going to keep using dollars, but on the old technology, as everybody else moves to using dollars on the new technology. But then I think you get into the question of, okay, well, are stablecoins just about dollars? And we don't think that they should be. We see stablecoins as a technology. And so we think every major currency should be represented on chain. And one of the best things that regulators could do is create the environment for that to exist. And right now, 99% plus of stablecoins in existence are dollars. Right. And so you're playing an uphill battle, but if there's value in this technology, if there's value in building products that are on chain, don't you want your currency to be able to be used on chain versus someone saying, oh, if they want to do anything on chain, they've got to use dollars?
Cuy, let me tell you, another great conversation that I can't wait to play for you is a conversation I had with Alisha Chhangani from the Atlantic Council. And she's been studying the movement towards central bank digital currency and a version of the same story. You know, one reaction to it is how do we get local currency issuance to move into the stablecoin environment? But another response from some in the official sector is to just basically issue a central bank digital currency. What she had to say was,
we hear a lot from central bankers, policymakers around the world that the ECNY isn't, people are using it, adoption has been low, there's not a lot of movement, but, data that came out of the PBOC at the end of December basically challenged all of those beliefs. ECNY usage domestically has gone up 800% since June 2023, so people are actually using the digital currency, the ECNY in China. We also look at kind of the international developments. That's a lot of the work that we do at the GeoEconomics Center. Project Enbridge, which is their cross-border CBDC project with many other central banks around the world, has moved away from the Bank for International Settlements to central banks controlling and managing the project. And they initially, in a pilot phase, did about $22 million in transactions. And now with the central bank's leadership, with China's leadership, it's gone up to $55 billion.
There's stable coins, tokenized deposits, central bank digital currency. We talked about narratives and how this stuff has evolved. I think when you and I first started talking about it, it was like any one of these three things could happen, and there may be different jurisdictions where one moves faster. Will one win out, or do you think we're just going to have to live in a world where there's different kinds of tokenized representations of money on blockchains, and they just all have to find a way to coexist?
I think they're all going to coexist. I think they could serve different use cases. I think it's really important to have interoperability between all three. And I think it's also really important to just start with like the practical reality of what exists today. And stablecoins exist today at scale, and they're continuing to grow. Tokenized deposits are just starting to come online. And there are, that I'm aware of, maybe 2 or 3 that are like live products that have any usage. I think that there'll be a lot more, and it will be a category, but they're nowhere near the actual adoption that stablecoins have today. And then CBDC, there are even fewer than there are tokenized deposits. And ECNY is one of the only CBDCs that is in production that has any real usage. And so I think all three will coexist. But like most things, there's going to be a balance between the public and private sector. And we've got to figure out, how do you maintain that balance in the right way? And how do you start with true product market fit of what end customers want, which today empirically are stablecoins. And I think it depends on the central bank, what their use case, what their focus is, what their competency is, and can they move at the speed that the entire financial system is moving right now. And so generally we find that stablecoins and tokenized deposits driven by the private sector with the right rules and guardrails and supervision over central banks, can accomplish most of the policy objectives and goals versus central banks having to try and become product companies and compete in a very competitive marketplace of many products that consumers and businesses are choosing.
Cuy, I feel like that last statement could be the mission statement for the Policy Sandbox podcast. Thank you so much for your time. How can people get a hold of you? How can people find you?
Thanks for having me. I'm on X at Cuy Sheffield and visa.com/crypto.
What a great conversation with Cuy. Now you know why he's my go-to resource for questions on all things digital assets. And that's a wrap on this episode of Policy Sandbox. Please come back and help me dig in with my guests. For more insight and practical advice from the Visa Economic Empowerment Institute, check us out at visa.com/VEEI.